Welcome to Spidell's California Minute. I'm your host, Catherine Zidane. This week, we're covering dividing property in a divorce and how that affects basis and the principal residence exclusion, among other things. Sign up for Spidell's quarterly tax update webinar, and you'll get reliable and pertinent updates on trending tax topics. Get details on this subscription webinar series and register for a full year of updates or just the upcoming session on October 22nd at caltax.com under webinars. Generally, no gain or loss is recognized on a transfer of property from an individual to a spouse or in trust for the benefit of a spouse. This is also true if the transfer is to a former spouse, incident to a divorce. An annulment is treated as a divorce for this purpose. This rule applies to all transfers at any time during the marriage, whether or not the taxpayers are contemplating a divorce. It also applies regardless of whether the transfer is of property separately owned by the transferor or is an equal or unequal division of community property. A transfer is incident to a divorce if either of the following occurs. The transfer is made within 1 year after the date the marriage ends, or the transfer is related to the termination of the marriage. In other words, any transfer required by the divorce instrument, even if made many years after the divorce, is considered incident to the divorce. Temporary regulations provide that a property transfer will be treated as related to the cessation of the marriage if it's made under a divorce or separation instrument, and not more than 6 years after the marriage ceases. According to the temporary regulations, if the transfer is delayed because of business reasons or a dispute over valuation of property owned during the marriage, and the transfer is made promptly after the dispute is removed, it is incident to the divorce, and the non-recognition provisions apply. Property transferred in a divorce has a carryover basis. This rule applies even if the transferred property is subject to liabilities that exceed the adjusted basis of the property. When computing the equal division of property, both spouses may have the benefit of the IRC Section 121 primary residence gain exclusion provisions if either elects to sell the house. A reduced exclusion is available if the taxpayers did not use the house for 2 of the last 5 years as a result of an unforeseen circumstance, which includes a divorce. An individual is treated as using the home as a principal residence during any period of ownership, while the individual's spouse or former spouse is granted use of the property under a divorce or separation instrument. The transfer of a passive activity under IRC Section 1041 is treated as a gift to the transferee. Suspended losses associated with a passive activity disposed of by gift are added to the basis of the activity and are not allowable as a deduction in any tax year. In the case of a passive activity held as community property during the marriage, it would seem that only half of the activity is transferred, while the other half is retained. Generally, if the basis in the hands of the transferee is greater than in the hands of a transferor pursuant to a tax-free transaction, the additional basis is treated as an improvement. The improvement has a separate holding period commencing on the date the transferee acquires the property. If the property is a depreciable asset, the transferee may depreciate it beginning on the date it is placed in service by the transferee. Presumably for depreciation purposes, the transferee has to allocate the additional basis among asset classes by some reasonable method. Transfers to a non-resident alien spouse are taxable even if the alien spouse is subject to U.S. taxation in the year of the transfer. Transfers to registered domestic partner would also be taxable for federal purposes. To stay up to date with California tax law changes, subscribe to Spidell's California Tax Letter. This monthly newsletter is written for California tax pros in plain English with helpful examples and charts. For subscription information, go to caltax.com and click Publications. That's all for this week. Join us next time for another episode of Spidell's California Minute.